Kirk Barneby, your Centre Active U.S. Treasury Fund has been performing very well this year. It's up around 4%. What's driving the Treasury market right now? Is it fear of slower growth, or is it all those foreign buyers?
It is at least those two factors, Greg, and probably concern about the strength of labor force activity in the U.S. as well. Not concern in the sense of slow labor force activity, but concern that labor force activity, which is exhibiting both positive level and momentum, may lead the Fed to begin to but to place less emphasis on some of the overseas events and continue in its path to policy normalization.
On the slow growth track, does the American public just not believe the Fed's view that things are getting better?
I think there is concern that things may not be getting better because of what we're seeing in the manufacturing sector, which obviously has suffered from the effects of weak growth overseas as well as the strength of the U.S. dollar. And I think there is concern because many members of the FOMC have characterized themselves as being data dependent, and in the data at which they look, they invariably mention the headwinds associated with overseas growth, both the weak growth overseas as well as the strength of the dollar.
Well, Mario Draghi is trying to do something about overseas growth, added more stimulus just this morning, cut rates just this morning. Can you trace that back to the Treasury market?
To the extent that, I'll try, to the extent that there is a view, a perception that the quantitative easing, the stimulus will be supportive of increased or improved growth, then I think the U.S. Treasury market suffers from a price perspective because, again, there will be less emphasis placed on weakness overseas and the policy deliberations here in the U.S.
Well, you have negative rates in Europe and Japan, and right now you have the 10-year Treasury at 1.9%, stubbornly below 2%. Where's it going to be at the end of the year in your view?
Again, as we've discussed in the past, I think that depends on a combination of real growth and inflation. Historically, there has been a well-established, statistically significant relationship between nominal growth in the U.S. and the yield on the 10-year Treasury. So if, in fact, real growth is consistent with the Fed's expectations, somewhere between 2 and 2.25%, and inflation reaches the Fed's target of roughly 2%, that would give you an implied yield on the 10-year of 4%. Now, are we going to go from 1.9 today to 4% at the end of December? Yeah, I don't know the answer to that, but that certainly should be the direction in which rates are moving.
It seems like it's all psychological, quite frankly, and as with regard to what's going on with the 10-year Treasury right now. Whether or not, who's right, whether or not the people who believe that the growth's going to be slow or the Fed?
Well, I think that's exactly right. I think what we're having is a contest in the marketplace right now between individuals who fear that things may get worse from a growth perspective and that we may not reach the inflation target.
And are they winning right now?
Well, with the Fed below 2%, I would say that they're in the lead, yes.
All right, and then finally, how much of someone's portfolio should they put into Treasuries at this juncture? I mean, it's behaving very well, but how much higher can it go? Can we get the 10-year at 1%?
Well, one of the reasons that we look at the portfolio on a monthly basis, as you know, is that we hope to be able to take advantage of periods of declining yields, but also to be able to help protect against rising yields. So if you are looking at Treasuries with no active management, simply a passive investment in your portfolio, then I think at this point in time you would have to be, it's probably appropriate to be cautious.
All right. Well, thanks a lot, Kirk. Always great speaking with you.
Thank you.
Thank you for watching The Street.